Hello everyone, this is Roy Güllüoğlu. Welcome back to the market update. Today, I'll briefly go over the economic calendar, the highlights of the financial markets since our last video. Then I'll talk about the Fed and its potential implications on the markets. I will also get into details of ISM and non-farm numbers that we received last week. So here you see the most important data flow since last week. First of all, as you can see, the employment cost index, it's important in terms of to measure the um, potential impact of cost, like employment cost to the inflation. It's kind of it's another indicator like an average hourly earnings. Like as we see an increase in employment cost index, we that would nourish the price wage spiral that Fed has been giving pretty importance on it. And USCB consumer confidence, it's for example much more growth related indicator, which gives some hints about the current situation of the economy. As we see more deterioration in this part, we would say that okay, since the confidence of consumers are decreasing, we can say that demand will decrease as well. That's why it signals a distortion in the economy. So other than that, we received some manufacturing number which came lower than expected. So yeah, and price also increasing. Jolts is another important data than the non-farm data. It's kind of preliminary data of non-farm. It's perceived like that in the market, but sometimes I have personally experienced a lot of time that the both data diverged. Like that's why it's not like okay, if this comes weak, non-farm's coming weak. There is no such thing. And Friday we received average hourly earnings and non-farm on Wednesday Fed, which I'll dig into a bit later. And average hourly earnings and non-farm on Friday, and ISM services data, the problematic part of the inflation side. Yeah, okay, let's start with the Fed. So the most important part of this meeting was about the reduction in the quantitative tightening. That means they're absorbing, like since they're not reinvesting their uh, new, like not new, but summing up all treasuries and other bonds, the Fed was allowing like 95 billion USD worth of bonds to roll over its balance sheet each month. So they decreased this number of 95 billion actually. So the 60 billion portion of what is UST, and 35 billion portion of this 95 is mortgage-backed securities. So this reduction is the decreasing the monthly cap to 25 billion USD from 60 billion USD, and the market expectation was uh, they like they were expecting them to decrease to 30 billion rather than 25 billion. So since the cap decreased more, that means more liquidity is allowed in the market is coming to the market, is going to come to the market by Fed. It's just $5 billion difference. This will start in June, and this part of Fed was perceived as dovish by the market, as it indicates Fed's desire to hold a larger portion of coupon bonds, like a longer duration bond. This definitely would put pressure on the long-term yields, as they're going to buy more long-term yields. Sorry, long-term bonds. The long-term yields going to come down, and like as you both like follow, like since with this higher for longer narration, um, especially long end of the curve, like moved really higher lately with persistent inflation and with the robust job market. So this reduction in QT also signifies their intention to maintain a significant coupon bonds in balance sheet. Here it's a great chart by Altea Spinozzi, the head of fixed income strategy at Saxo Bank. With the previous cap, as you can see, the previous cap was here. The Fed would have retained only 53 billion in coupon bearing USDs just within a year. However, the new cap allows the Fed to retain approximately 300 billion in such treasuries, and this number is 25% higher than the expected 30 billion cap. So especially like the 5 billion seems maybe not that much compared to expectation, but it allows, like, it creates 25% more, kind of like, it's not strictly correct to say like this, but it's creating like 25% more liquidity, we can say, maybe. Yeah, so what does this imply? Let's go through another chart from Altea Spinoza, sorry. As you can see, this chart is showing actually the supply of US treasuries by the government. And as you can see, the June here, there's a huge spike. This part is the second quarter of 2024. And yeah, just at the same time with the QT reduction starts, which is June, just around that time, the highest US bond issuance since 2022 is coming. It seems like the additional that 5 billion is also there to absorb this additional debt issuance. Like since that monetization, which is like as they print more, as they government comes with more bonds, like treasuries, Fed's coming inside, and this kind of create like this that monetization potentially creates inflation, and we might see the investors ask for higher inflation premium. This would push the long end of the yield curve higher. So overall, I really don't want to contradict with myself with the previous slide, but let's overall wrap up like this. The reduction of the in like quantitative tightening might put pressure on the long end of the yield curve and lower the long-term yields in the short term. However, with the increasing debt issuance, this debt monetization, like this increase in the supply of bonds, we might see it to contribute to inflation, which leads to higher long-term yields in the long term. Maybe they're going to cancel out each other, and this will result in maybe new normal of higher rates compared to the previous times, like, because like maybe like this 2% inflation target is not that realistic in these terms. So yeah, what were the messages that we received from Chair Powell press conference? Powell is like, let's briefly summarize. So far this year, the data have not given us that great confidence, he said. In particular, readings on inflation have come back in above expectations. It's likely that gaining such greater confidence will take longer than previously expected. Also, the current policy is restrictive, he said, and acknowledged the slowdown in interest rate sensitive sectors of economy. He mentioned improvements in the labor market compared to previous years, with many data series nearing pre-pandemic levels. However, in the March job openings and labor turnover survey, which is JOLTS, showed weaker demand for US labor with fewer job openings and hires. This shows a deterioration in the labor market and a lower quit rate compared to before the pandemic. Currently, there are 1.3 job openings for every unemployment person, which is a really important indication for them because they have been following this since the COVID, and they believe that they will see an improvement in the inflation just after this coming back to a normal balance in the job market. That's why this 1.3 number, which is the lowest since 2021, is pretty important. So with improved labor market supply and demand, consumers are also, as I said, expected to slow spending after a period of robust growth, and leading to a decrease in inflation and economic growth in 2024. And lastly, he said, let me check, that they're prepared to maintain the current target range for the federal funds rate for as long as appropriate. So yeah, more or less, there is not much new thing. Like uh, Powell's rejection of rate increases is another important topic. Was another important topic of this conference. Of this meeting. Alongside it, he dismissed of immediate rate cuts. So combining these two imply a commitment to higher for longer approach, actually. And the timing of the first rate cut remains unclear. Yeah, let's see what's market priced just after the meeting. Here in this chart, you can see just before Fed, the market was pricing only, like, let's say, one rate cut until the end of this year, and just after the meeting, this until the end of year, like there's a one certain rate cut, and the other one is 81%. That implies that one. So as you can see, the difference, like the switch just happened after the meeting. Yeah. And yeah, non-farm payroll data, the market expectation was 240K, but yeah, non-farm payroll came to 240K, and yeah, the data came 175K. As you can see in this chart, also there's the trend is seems like coming down. The prior data was 3K, and this decrease is like pretty important. Like it's really like weaker than expected data, and 2-month revision is negative 22K. As you might recall from our like previous videos, like these revisions are pretty important to get some hints about the major trend on non-farm payroll. Yeah, this downward revision also aligns with contracting economic activity. Within this, like in this non-farm data, within the service segment here, you can see private service providing these part. The leisure and hospitality part increased by only 5K, as you can see here. You can see like it's like 42K, 26, 53K, and now it's 5K. You can see some like distortion, which is pretty low compared to prior data. Like, yeah, the temporary help services are negative 16K. So these numbers also explain the low ISM service data that I will get into details to ISM data a little bit later on. If the economy is really doing well or in a high demand environment, companies would need help from like third party, right? And we see like this, the temporary help services are negative 16K. That's pretty important indicator as well. Also, another important thing here is the 3-month average number. As you can see here, you can see the trend is coming like down, like from 269 to 242. Yeah. So, okay, let's get to average hourly earnings now. Yeah, the year-over data decreased to 3.9% from 4.1%. The expectation was 4. This is the lowest since June 2021, and month-over-month increase came to 0.2. And the expectation and the previous data was 0.3%. As you can see in this chart, this is a really positive sign. As this number comes down, we might be hopeful about the potential occurrence of the potential price and wage spiral risk. Yeah. Also, I would like to few words about the unemployment. Like in general, like non-farm data is weak. Like as you can see, like while it's like the economy is deteriorating, uh, it's a good sign to get like at the beginning of last week, the employment cost index was rising and stuff, but the average hourly earnings is coming a bit down. I mean, it's not like highly important decrease, but at least it's something. And seemed like it's like in general non-farm data was like market friendly. Yeah, unemployment rate, a few words about that. It increased from 3.8 to 3.9. There, I mean, there are some questions about like increasing unemployment while there are like, I mean, in an economy, just imagine if there is a 175k non-farm new jobs coming, how can the unemployment increase? That's the question. Sometimes like people are questioning. Yeah, for the one, it's actually totally like they're like a different surveys actually. One is household survey, as you can see in this table. One is payroll survey. Payroll is the source of this survey is the source of the non-farm number, and this household survey is the source of the unemployment number. So the payroll survey, the non-farm, is designed to measure employment hours and earnings in the non-farm sector with industry and geographical detail. The survey is best known for providing highly reliable measure of monthly change in non-farm payroll employment. It's kind of a representative sample of businesses. It's more from a business side actually in United States, and it provides uh, data about like a payroll survey. While on the other hand, the household survey, unemployment rate is designed like unemployment rate is derived from there, and it's designed to measure the labor force status of civilian non-institutional population with demographic detail. The national unemployment rate is the best known statistic um, produced from the household survey. It's like the difference is the mentality. One is looking from business's perspective. One is looking from household's perspective. You can differentiate like that. Yeah. And yeah, lastly, like I would briefly like to touch upon the ISM data number that we received also in Friday. The forecast for the service PMI number was 52. It's lower than expected. 49.4 mark has been the second data in the contractionary region since December 2002. It was 49. Why I'm giving more importance to the service side, by the way, because on last Wednesday there was ISM manufacturing data, but I'm here just showing ISM. In this chart, you see this guy here is ISM service PMI, ISM services price, ISM. Why always services? Because it's the service part is the problematic part of the inflation. I'm trying to trace any distortion on that side to confirm the progress of inflation. If we're gonna see the continuation of the disinflation period, we need to see an improvement in this chart, like this chart to come down, like this number to come down. So yeah, as you can see in this chart, the ISM service prices increased 59.2 from 55.4. This is not that good. The forecast was 55 in terms of inflation. As the service prices increases, as I just mentioned, it's the problematic part of the inflation. So it will contribute more to the inflation. However, like the service employment on ISM new order surveys are signaling here. You can see, this is the ISM service new orders. It's erased, I guess. Yeah. So it's coming down. Those like ISM new orders and service employment are signaling a contraction in the economy. It's a good sign in terms of the impact of tightening and monetary policy, but a bad sign for the economy. So yeah, overall, just to wrap up, what all this like Fed, ISM, non-farm, where are we? Like it's generally the main question. Like people are getting lost in these kind of like general analysis. So overall, like what do we have in our hands? First of all, lower than expected non-farm data we have, lower wage-based inflation risk, and we received an ISM data in contraction region, right? So considering these factors mentioned, market anticipation has risen regarding the likelihood of earlier rate cuts and the number of rate cuts. From now on, we need to find out if the soft landing scenario will start to gain its power back. That's the main uncertainty actually. Accordingly, I still believe that positioning in precious metals and quality stocks is the best scenario in market corrections. What's the downside? What's the risky side of this mentality? The risky side of this is the soft landing part, this uncertainty. The continuation of disinflation should be achieved without distorting the growth of the economy. Thus, the companies sustain their profitabilities. So this mentality of, okay, if the rate's coming down, equity is going to do well. It's not enough for equities to do well. At the same time, the soft landing should be back in the game. So the level of aggressiveness on US equities should be calibrated really cautiously. But because of this, the soft landing part that I mentioned. So considering PE differentials, European or developing market equities seems like offering more room compared to their US counterparties. So summing up this uncertainty, potential geopolitical tensions, also like at the beginning of this week, potential escalation in between Israel and Iran again, and upcoming rate cuts to that potentially elevated the continuation of disinflation. I think this combining these three make the precious metals attractive to me still. So I would see any correction as a buying opportunity in gold and silver. As you can see also in this chart, in these charts, here is gold. There's this is a weekly chart, pretty long-term chart, huge breakout. This line is 10-week MA. This is 40-week. These are considered as like a long-term moving averages. As you can see, I would evaluate these lines as a trend followers. Here also in silver, as you can see, we saw a huge breakout, then pulled back to the support level. Old resistance and new support level, and still, as you can see here, long-term moving averages carrying prices up. So that's why, that's all I'm going to tell you this week. I hope you found all information that I tried to provide helpful. If you enjoyed what you watched, please consider subscribing to our channel, Marketsall, for more content like this. And please don't forget to hit the like button. And thank you for watching. We'll see you in the next one.